So in this lecture, we are going to discuss inventory. As you know, inventory is an asset. It is a current asset reported on the balance sheet. Inventory is something a company keeps. For example, we talked about three different kind of companies. One is a manufacturing company, one is a retail company, and one is a service provider. So manufacturing companies have raw materials such as manufacturing companies has three kinds of inventory, such as raw material, work in process inventory means unfinished goods, and finished goods. And the service company provides only service and they do not have any inventory. Other companies such as retail companies, Walmart, Best Buy, they have finished goods inventory, and these inventories we going to discuss how we report this inventory and how this inventory affect our business. So retailers and wholesalers typically hold what we call merchandise inventory, like Best Buy. So good purchase to resell without doing any additional manufacturing or any other thing. And manufacturing companies, as I said, report three kinds of inventory: raw material, work in process, and finished good inventory. Now, inventory system or inventory uses two different kinds of inventory system. One is called periodic system and the other is called perpetual system. What does it mean? The periodic systems keep track of inventory at the end of the period. As we discussed before, what is a period? A period could be a month, it could be a quarter, it could be a year, or it could be semi-annual 6 months period. So in periodic inventory, we track inventory at the end of the period, and we decide how much inventory is left and how much is our cost of goods sold. In perpetual inventory, we update our inventory system at every transaction. After every transaction, we update how much inventory we have on hand and how much inventory has been sold and becomes cost of goods sold. The next thing we're going to talk about, what are the things that are included in our inventory. What do we call inventory? So inventory typically consists of goods in physical possession. So for example, Best Buy has TV, fridge, computers, VCR, DVD players, things like that. Goods in transit. Goods in transit means either Best Buy is bringing goods from, let's say, for example, from Sony TV. So they are in transit coming to the stores, or Best Buy is selling those goods to the customers and they are going to the customer's house. So we have two things that we talked about over here. One is called shipping. Goods are shipped, so it's called the shipping point, and the second one is called destination. So what is the difference? If goods are shipped shipping board, then the title or ownership passes from the seller to the buyer when the goods are shipped. So what simply means, so as soon as Best Buy shipped you your TV, while it is in transit, means suppose the Best Buy is shipping you a TV from Arizona and you live in Dallas, Texas. So while the TV is in transit, or say UPS is bringing from Arizona to Dallas, during that time, the customer own the TV. The buyer reports the goods in its inventory while in transit, means, so if you are buying it, so that will become part of your inventory. So once they ship the product using shipping point, the title passes to the buyer. So the inventory for the seller is going down and the buyer inventory is going up. That's the only thing you need to know about this. If the goods are shipped FOB destination, the title passes from the seller to the buyer when the goods received by the buyer. So for example, if they are shipping using FOB destination, the title or the ownership of the of the TV will only be passed to the buyer from the seller once the buyer receives the product in Dallas. Okay, now some students usually ask questions. So when we use shipping point or destination, it is between seller and the buyer. They have to negotiate what shipping terms they are going to use in this transaction, whether they want to use shipping point or whether they want to use FOB destination or FOB shipping point. Is between the buyer and the seller. Okay. The next thing we're going to talk about, cost included. So what cost included? Of course, the price of the goods are always included in the cost of inventory. The next thing is manufacturing cost, of course, freight cost. Usually the buyers pay the freight cost. Packaging and handling cost, freight out cost. The freight out cost is the seller cost. That's the transportation when you're going to sell it. So that's not usually a part of inventory. It's always a part of the selling, journal, and administrative. Most questions will tell you that it's a part of that. So freight out cost is a part of the sales. Don't make that mistake in the exam. The rest of the information goes into the inventory cost. All right. Now, the next thing we're going to talk about how we determine the cost of merchandise inventory under a perpetual system. In the perpetual system, we use three things: a specific identification method, first in, first out, last in, last out, and weighted average method. A specific identification method is used for very unique and precious items. Last in, first in, first out, and last in, first out is used for things that are mass produced, such as Coke can of Coke, or a beer can. So these are the things that are cheaply available, mass produced. We use first in, first out, last in, last out. Weighted average is used for things such as maybe computers, TV, fridge, these kinds of things. But a specific identification method is used for unique, custom made, very precious, very expensive items. Okay, so a specific identification method costing based on a specific cost of unit of inventory. The I is missing here. Okay, first in, first out. Assume the first unit purchased or the first unit to be sold. So first in, first out means the old inventory is going to be sold first. Old inventory sold first. All right. And ending inventory closely reflects current replacement means cost. New inventory is always on hand. Cost of goods available for sale is the total of cost spent on inventory that was available to be sold during a period. That's all cost of goods available for sale. So if you want to make a inventory T account, so you have a beginning balance and you have a purchase. This will give you goods available for sale. And once whatever you have sold, cost of goods sold, if you subtract that, you have ending balance of inventory. Okay. Whether you use a FIFO method, whether you use a LIFO method, or whether you use a weighted average method, you can use this T chart in every scenario. Okay. The last in, first out method is the opposite of FIFO method, in which you will sell sold new inventory first. Okay. Cost of goods sold represent the current replacement cost. Ending inventory always contains the oldest items. Now we're going to talk about gross margin. Gross margin is very simple, is revenue minus cost of goods sold is equal to gross margin. So gross margin is difference between revenue and cost of goods sold divided by the revenue. So you can say that the gross margin is the difference between revenue and cost of goods sold. It is calculated that the selling price of an item less cost of goods sold, then divided by the selling price. So gross margin is equal to selling price minus cost of goods sold, and gross profit margin is gross profit margin divided by the sales revenue. Okay. Inventory turnover ratio measures how rapidly inventories, or rapidly means how quickly you sell the inventory. So for example, are you selling, so let me give you an example. Suppose you have an inventory, you sell 100 items in a month. Well, that's very nice, but what if another competitor sells 100 items in 15 days? That means he's making double than you are making. Or maybe a third competitor is selling 100 items every week. So that means the third one is making 4 times the first one and double the second one. So that's inventory turnover. The ratio should be evaluated against industry average, of course. A high turnover rate indicates ease of selling. Ease means easiness. The low turnover indicates difficulty of selling. Days of inventory. So if you want to say inventory turnover, cost of goods sold divided by average inventory, and average inventory is equal to beginning balance plus ending balance of inventory, beginning balance of inventory, ending divided by the 2. So this is the average inventory. And if you are so days inventory measure the average number of inventory is held by the company, so you can take care of that. Sometimes some will move faster than the other, such as fruits and vegetables. For inventory with an expiration date, this measure is very important. Okay, so we're going to stop here with our inventory. And then we're going to discuss in the next video about long-lived assets or fixed asset